we're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign of what's going to happen to these other workers moving forward. And I talked a little bit about...
Welcome to the Crypto Teacher. And guys, you know I come back with that second video just to make you think. And we know Jerome Powell met today, where everybody's distracted on Bitcoin. The actual people that took us to 21,000 is talking, and nobody's talking about them. But let's thank the Fed for getting us to 21,000. Give them a round of applause, because they're pumping us, guys. And in this meeting, they actually admitted they're pumping us. They're pumping everything, guys. Now, basically, of course, they went over their goals is for maximum employment. Is that correct? No, it is not, because they're the ones who are responsible for putting all these people out of work. Inflation 2%. Is inflation over 2%? Go to your grocery store and you tell me. But of course, they don't include the grocery store in their inflation numbers. No, they don't. Now, guys, also they talked about the lending facilities, how important they are. Now, guys, we know that 4 of them are going to be closing on December 31st. So we know when it comes to this first quarter, we're going to take a hit. Don't let anybody fool you. We're going to take a hit, guys. But they did say they're still going to be buying treasuries and mortgage-backed securities. So, guys, that's not going to stop for right now. So they're still going to be adding to that balance sheet. Remember, it's already $7 trillion. 10, 11, 12, 13. What's the big deal? Guess who's going to pay for it? That's right, you. And your kids' kids. And your kids' kids. Now, guys, this is probably one of Jerome's worst performances, because he clearly was reading the whole thing. But he said some very, very important things in this meeting that we needed to hear. He said the first quarter is going to be very challenging. We know this, but the Fed finally says it. He also says we need to get through these first 4 to 5 months and we're going to be fine. That's nothing the Fed has said yet. So we know, guys, the C word is going to be coming to an end. So we know the C word was to do what? Distract the people so they could get these repo facilities, get us moved over to the fourth industrial revolution. While they gradually making moves, people are worried about paying bills. That's how they do it, the big distraction. Now, the Fed also stated they're going to be keeping the dollar swap lines open for non-central banks until September 30th, 2021. So, guys, this time frame is exactly where I had put it. Remember, we get the stimulus. That'll last us until June. And then, of course, the big crash in September. That's right. Of course, we're going to have a correction the first quarter. And they can blame it, of course, on the C word. It's already set up. Now, basically, as far as with the housing is concerned, guys, don't forget that they're trying to push Freddie and Fannie back to private. We know how many people are not paying their mortgages. We know how many people are not paying their rents, guys. Don't let the Fed fool you. Yes, there is a housing boom, but it's a housing boom for who? These big corporations that are buying up, these investors that are buying up this housing. The regular person off the street who has a job, they're going to buy a home, but they're not educated on the future. They don't understand the fourth industrial revolution. You will own nothing, but you will be happy. That's right. Now, of course, the Fed said something very interesting. They said they have joined the climate change. How many times have I went over this, guys? The agenda is here. Now you're going to have money behind the climate change. We know something as big is about to happen. And Powell said that U.S. treasuries are wanted worldwide. Is that correct? Yes. Because just about everybody else is negative. But the fact is that what did Jamie Dimon say? He wouldn't touch the treasuries with a 10-foot pole. Remember, guys, that everything the New World Order does is already planned out. including Bitcoin at 21,000. Enjoy the rest of the video, and remember, Jerome is in the house.
Of the financial system. As noted in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. We've also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances, such as those we find ourselves in today. What do we mean by that language? And really the overarching message, Rich, is that our guidance for both interest rates and asset purchases will keep monetary policy accommodative until our maximum employment and price stability goals are achieved, and that's a powerful message. So substantial further progress means what it says. It means we'll be looking for employment to be substantially closer to assessments of its maximum level and inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases. I would also point out that involves people getting together in bars and restaurants, on airplanes and hotels and things like that. And you're starting to see that. In the high-frequency data, you're now beginning to see that show up. And I think this is the case numbers are so high and so widespread across the country that seems like it must happen. Now, how big will it be? We don't really know. You know, there are a lot of estimates. The general expectation is you're seeing some slowing now. And you'll see the first quarter could well be, what we said is that coming months are going to be challenging. The first quarter will certainly show significant effects from this. At the same time, people are getting vaccinated. Now they're getting vaccinated. And by the end of the first quarter, into the second quarter, you're going to be seeing significant numbers of people vaccinated. And so then how will that play into economic activity? Again, we don't have any experience with this. You have to think that sometime in the middle of next year, you will see people feeling comfortable going out and engaging in a broader range of activities. And some people will be probably quick to do that. Some are doing it now without a vaccine, right, in many parts of the country. So nonetheless, my expectation, and I think many people have the expectation, that the second half of next year the economy should be performing strongly. We should be we should be getting people back to work. Businesses should be reopening and that kind of thing. The issue is more the next 4 or 5 months. Getting through the next 4, 5, 6 months, that is key. And clearly there's going to be need for help there. And my sense and hope is that we'll be getting that.
And concern, especially as it related to your mortgage-backed security purchases. And you mentioned earlier today that the housing market looks more or less fully healed. And so I guess I wonder, are you worried about valuation pressures there? And if so, what can the Fed do to contain those?
We monitor basically just about every asset price in the economy, and housing prices are something that we've been monitoring. And you see them moving up. You see very high demand. This is the housing market that people have been expecting since 2010, and then not many when the pandemic hit thought, oh, this is what will produce that housing market, but it has. Now, I would interest rates that stimulates demand over time and works with long and variable lags. It's really support as we've talked about this as all of these government policies trying to work together to create a bridge across this economic chasm that was created by the pandemic. And for many Americans, that bridge is there, and they're across it. But there's a group for which they don't have a bridge yet, and that's who we're talking about here. It's the 10 million people who lost their jobs. It's people who may lose their homes. It's you see the many millions of Americans are waiting in food lines in their cars these days all over the country. So we know there's need out there. We know there are small businesses all over the country that have been basically unable to really function, and they're just hanging on. So and they're so critical to our economy. So, and by the way, now that we can kind of see the light at the end of the tunnel, it would be bad to see people losing their business, their life's work in many cases, or even generations worth of work because they couldn't last another few. Network for Greening the Financial System, which we joined this week, and I'll just say a couple things about that. So first, I'll just start by saying that we're going to move carefully and thoughtfully on developing an understanding of how climate change affects our work, including the areas you mentioned. We're going to do so with a great deal of engagement with all of our external constituencies, including the public and their elected representatives who are charged with our oversight. We'll do it with great transparency. Remember that we are a non-political agency whose goals and authorities to achieve those goals are set by Congress. We have great responsibilities and strong authorities that we'll use vigorously. We're not the forum where all the great issues of the day are to be hashed out, debated, and addressed, unless and only to the extent that those issues are directly relevant to our statutory goals and are addressable through our legal authorities. And because we have a narrow remit and because we stick to it, Congress has given us a precious grant of independence from direct political control. So society's broad response to climate change is for others to decide, in particular elected leaders. But so let me get to your question. What does all that mean for an issue like climate change, and why did we join the NGFS? So Congress hasn't explicitly assigned us or other financial regulators a role, and we're not among the agencies who contribute to the National Climate Assessment, for example. But climate change is nonetheless relevant to our existing mandates under the law, and let me tell you why. One of our jobs is to regulate and supervise banks and to look after the stability of the financial system. That's a responsibility we share with other agencies. The public will expect that we will do that. So we'll expect that those important institutions will be resilient against the many risks that they face: credit risk, market risk, cyber risk. Climate change is an emerging risk. I don't think it's at all a foregone conclusion that there needs to be a permanent Fed presence, and we certainly don't, that's not something we're planning on or intending. Right now, we're buying assets because it's a time when the economy needs highly accommodative monetary policy, and we think our asset purchases are, one of the main delivery mechanisms for that. The size of the balance sheet. There's lots of demand for U.S. Treasury paper from all over the world, and